ETFs and mutual funds are two of the most popular investment vehicles today, but there are a few key differences worth exploring.
Go ahead, explore.
In this video, I'll discuss the similarities and the differences between mutual funds and exchange-traded funds, ETFs, to help investors like yourself choose which of the two vehicles is the best fit for your portfolio. I'm Sean with The Modest Wallet. Consider subscribing. It doesn't cost you anything and really is a huge support of the channel.
I support that.
Also drop us a comment, ETF or mutual fund, so we know which one you prefer between the two. If you're undecided, hopefully this video will help you make a decision which one is best for you.
Trust me, it's for the best.
For many decades, mutual funds were considered the most effective way to build a diversified investment portfolio. This is because they allow users to rely on the services industry professionals, otherwise known as financial advisors, already overseeing a huge amount of assets on behalf of less experienced or busy investors. With that said, the launch of exchange-traded funds, ETFs, in 1993 in the US, that revolutionized the entire asset management industry. These investment vehicles proposed a cheaper and maybe even more efficient way of allocating capital through a fund, as investors could more easily enter and exit their positions. Before we go any further, let's break down what an ETF is, or an exchange-traded fund, and a mutual fund are. An exchange-traded fund, or otherwise known as an ETF, gives the holder ownership over a fraction of a diversified portfolio built by the financial services company that runs the fund. Shares of these funds can be easily exchanged as if they were a regular stock through one of the many exchanges that's in the United States, the New York Stock Exchange, the NASDAQ. Their value fluctuates primarily based on the underlying value of the stocks held by the fund. Most ETFs hold a diversified basket of securities. The type of assets they invest in depends on their strategy, scope, or reach. ETFs can focus on a certain asset class, something like a stock, a bond, a cryptocurrency, a geographic area, so maybe US or foreign stocks, a specific sector, so industrials or healthcare, etc., or a particular investment strategy like investing in dividend, growth, or value stocks. Investors actually pay an annual management fee that is typically expressed as a percentage of the ETF's quoted price. The fee is used to compensate fund managers for their services and to cover the fund's operating expenditures. Additionally, investors have to pay all transaction fees involved when trading ETFs. That said, most brokerages firms nowadays offer commission-free trading for US-listed ETFs. Finally, depending on the fund strategy, an ETF can be either actively or passively managed. Actively managed funds typically display a higher turnover rate, meaning that the manager buys and sells assets more frequently to really take advantage of market conditions. Meanwhile, passively managed funds track a certain index, and their holdings will usually receive a weight that is the same as that assigned by the index. I have an entire video all about ETFs. I'll leave a card above for you to check that out. Now let's talk about mutual funds. A mutual fund is a financial vehicle that gathers money from investors to build an investment portfolio that follows a certain strategy or methodology. Mutual funds were considered for many years to be the easiest way to invest in the stock market, as investors would rely on industry professionals to often do the heavy lifting. Some mutual funds issue shares whenever a new investor comes on board. That's called an open-ended, while others issue a fixed number of shares, closed-ended. Therefore, these funds typically require a minimum investment and charge load fees to cover the cost of each transaction. This load fee also aims to discourage investors from trading shares frequently. The value of a mutual fund is determined by the combined value of its holdings. That said, for closed-ended funds, the price of every share could vary based on supply and demand dynamics. These funds are typically offered and managed by financial service companies, and they can either be actively or passively managed, while their scope, reach, and strategies vary in the same way as ETFs. Hopefully that explains ETFs and mutual funds. Now let's look at a few of the main differences between them. First is the strategy. Even though much has changed in the financial industry, In the past couple of decades, mutual funds are typically considered actively managed funds. So this means that fund managers have more influence on which assets are incorporated into the portfolio instead of just tracking a certain index. Nowadays, whether a mutual fund is passively or actively managed depends largely on its strategy. Index tracking funds will typically be passively managed vehicles, while more complex strategies such as growth, dividend, and value will give the manager more freedom to incorporate or exclude certain assets from the portfolio. Because of that, the fund's performance will be measured against a certain benchmark, but will not necessarily be expected to perform equally or even similarly. Meanwhile, exchange-traded funds are mostly passively managed vehicles. Although there are exceptions to that case, the reason for that is that the lower portfolio turnover rates tend to keep expenditures at bay, and that allows these funds to change lower annual management fees, a key feature that has made ETFs significantly more attractive than mutual funds. The next difference between ETFs and mutual funds revolves around trading. Since exchange-traded funds, ETFs, are structured and listed as if they were a regular stock, they can be traded at any point during the trading session, intraday trading, that's what that's called. Meanwhile, mutual funds are typically traded once the session ends at the closing price, as these funds typically report their daily net asset value, the NAV, once the session ends. Another difference are the management and fees involved. There are two fees to consider when investing in ETFs and mutual funds. Transaction fees, which encompass all non-management fees involved when purchasing the instrument, and management fees, which are all those paid to the company that operates the fund. This last one is typically expressed as a percentage. For ETFs, non-management fees are typically the commissions or fixed fee charged by the broker to buy and sell the instrument. Meanwhile, mutual funds tend to charge load and redemption fees. Taxation is another difference between mutual funds and ETFs. Because of the way exchange-traded funds are structured, they have lower asset turnover rate and other factors helping minimize capital gain taxes. Since ETFs are traded as if they were a stock, they are less sensitive to fluctuations in their inflows and outflows, as most transactions can be settled between third parties instead of the fund having to issue some new shares or redeem existing ones constantly. As a result, managers will not necessarily be forced to liquidate the fund's holdings to fulfill those redemptions. Mutual funds, on the other hand, operate differently, as share purchases and sales are typically handled by the fund itself. Therefore, when an investor liquidates a sizable position, the fund will typically be forced to sell some holdings to meet the redemption, and that will cause a potentially disadvantageous capital gain. Since mutual funds are mostly actively managed, their asset turnover rate is commonly higher, and even though the fund may adopt the tax harvesting strategies, its tax bill might end up being higher compared to that of an ETF under similar circumstances. The next difference between ETFs and mutual funds is transparency. Due to their respective frameworks, ETFs are typically obligated or opt to disclose their individual holdings daily. Mutual funds, on the other hand, typically disclose their holdings on more of a quarterly basis. Last but certainly not least are the investment minimums when it comes to differences between mutual funds and ETFs. The minimum amount required to invest in an exchange-traded fund is the price of one share. That said, most brokerage firms nowadays offer access to fractional shares for US listed ETFs, and that reduces the minimum investment required to incorporate these instruments into a portfolio as little as $1. Meanwhile, most mutual funds require a minimum investment starting at around $1,000, and they impose a lockup period of up to 90 days. During this period, investors cannot redeem their shares unless they're willing to pay a penalty for doing so. I hope that helped you understand the basic differences between mutual funds and ETFs. There are good reasons to use either as an investment tool, and here's why we like ETFs. The reasons are as follows: expense ratios are low, asset turnover rates are low, the minimum amount required to invest in an ETF is its price or lower if investors are allowed to buy fractional shares. They can be a great alternative to build a diversified portfolio regardless of its size. ETF structures are considered more tax efficient than mutual funds. I can't just let you know about the positives of ETFs without mentioning why we like mutual funds. Here's why. Actively managed funds can outperform passively managed vehicles under challenging market conditions. Large brokers may offer a great selection of no-load and inexpensive index funds. Automated investments can typically be set up, and this is a great feature for building retirement funds or autopilot mode. So that's why we like them, but now let's briefly discuss when you should use each one. Use ETFs if you are seeking to build a diversified portfolio without putting too much thought into which individual stocks should comprise it. Exchange-traded funds are perhaps the best alternative, as these instruments can provide exposure to multiple asset classes, industries, geographies, and strategies. Nowadays, most brokerage firms charge no commissions or fees for trading US-listed ETFs, and that reduces transaction costs for even the smallest portfolios. Moreover, the introduction of fractional shares for ETFs has allowed retail investors with a small account balance to build highly diversified investment portfolios with as little as $50 or $100. Now, this is when you should use mutual funds. Mutual funds have lost most of their decades-long popularity after ETFs started to showcase the many appeals they have. However, they might still be a good pick in some specific circumstances. For example, use mutual funds if you are expecting that market conditions will deteriorate in the future. You could opt to pour some of your capital into funds managed by seasoned professionals, financial advisors, who know how to navigate those troubled waters. Also, some 401ks may only offer access to mutual funds for getting exposure to certain asset classes, geographies, and strategies. Personally, my retirement portfolio has a mixture of ETFs and mutual funds. It's really up to you, but there may definitely be some benefits based on your individual needs and goals. That's all I have. Thanks so much for watching and checking out our video. Be sure to check out our other Money Made Simple videos, and don't forget to smash that like button. I'll see you in the next one.